if a stock yields 4% and a bond yields 4%, which was what he was talking about then, the stock was going to outperform the bonds because there were retained earnings that were building beyond that yield. And that has been true for a long, long time, but nobody paid any attention to it. We don't get rich on our dividends that we receive, although we're happy to receive them. We get rich on the fact that the retained earnings are used to build new earning power, repurchase shares, which increases your ownership in the company. And Berkshire has retained earnings ever since we started. That's the only reason Berkshire's worth a lot more, as we retain earnings.
We'll move to the second slide. I give you those operating earnings figures just to give you a overview of what has happened since the pandemic started, and often the year before as a base. And we retain all our earnings, as you know. So if we're retaining 30 or 35 billion or whatever it may be a year, you should expect more operating earnings over time. I mean, this number should be significantly higher 5 or 10 or 15 years from now, because we have the advantage of retaining earnings. And that's what got us to these figures, because they were essentially nothing when we started. And they got there by retaining earnings, and we'll keep retaining earnings. So it's no great triumph if these numbers move up. And what we hope is that they move up at a reasonable rate. Historically, they moved up at an unreasonable rate sometimes, but we were working with much smaller sums then, and that can't be repeated with our present capital base. And you'll notice that every year the number of our shares go down. So if we own more businesses and the businesses make more money, your share as shareholders, as owners of Berkshire, increases every year without you laying out any money. Now, you're laying out the alternative, which you could receive in dividends, but the reason we've gotten to where we are is because we kept the money. We did pay a dividend in 1967, 10 cents a share. It was a terrible mistake. And I always tell people that I'd left for the men's room and the directors voted while I was gone, but that isn't true. I was there, I confess. But we reinvested, and that's produced the 500 billion plus of shareholders' equity and the 30 billion plus of operating earnings. And we'll continue to follow that policy because it makes a great deal of sense.
We won't stick a price on them. We tell you that they are absolutely wonderful businesses run by sensational people, and that they are selling at prices that are higher than they've sold at most of the time. But that, they may well be worth it, and worth a lot more, even in terms of present terms, or it may turn out they're a couple of years ahead of themselves. We don't know the answer to that. We know we're very happy owning them. Gillette does not repurchase its shares, or hasn't in any significant quantity for many years. Coke consistently repurchases its shares. We generally like the policy of companies that have really wonderful businesses repurchasing their shares. There aren't that many super businesses in the world, and the idea of owning more and more of a company like that over a period of time has an appeal to us, and almost an appeal regardless of price. The problem is that most companies that repurchase their shares, are frequently so-so businesses, and they're being done for motivations other than intensifying the interests of the shareholders in a wonderful business. But where you really know you have a wonderful business, and we think most of the ones we own are anywhere from extremely good to wonderful, we think it usually makes a lot of sense. It's hard to do things intelligent with money in this world, and Coke has been very intelligent about using their capital particularly to fortify and improve their bottler network around the world. I mean, they've done a terrific job that way. That was a neglected area for a long time, and that comes first. But there's only so far you can go with that, and to enhance the ownership of the shareholders in a company like Coca-Cola. When we bought our first Coca-Cola in '88, we bought about 6.2% of the company. And at that time, they may have been 600 million servings, not any more than that a day. So we had an interest in 36 or 37 million servings. Now we have 8% of 900 million plus. So we have an interest in 75 million or so servings a day. 75 million people are drinking Berkshire Hathaway's share of Coca-Cola products today in an 8-ounce serving. And the profit's gone up a little per serving. So that gets pretty attractive. And we just assume they keep doing that. The bottling thing's actually kind of interesting. And a fellow from Omaha.
By and large, we feel, perhaps unjustifiably, but so far justified, that we can create more than $1 of present value by investing. Sometimes, if the stock is cheap, we can create more than $1 of present value by simply repurchasing shares. But even if that option isn't available, we feel that by every dollar we retain, we can turn that into a greater than $1 of present value. And for 47 years, that's worked. I mean, we have every dollar retained is turned into more than $1 of value. So if somebody wanted to create their own income stream out of it, they were much better off selling a little bit of stock every year than they were by getting a dividend out of it. They would have more money working per share in Berkshire if they sold off 2% of their holdings than if we actually paid them out a 2% dividend. So the math has been compelling to this point. Now the question is whether we can keep doing that in the future. But so far, at any point in our history, if we'd paid out dividends, and I paid out 10 cents a share back in the 1960s, which was a big mistake. But if we won't repeat that. If we'd paid out dividends, our shareholders net would be worth less money than they are by having left it in. And I think that will continue to be the case, but who knows? Charlie?
Well, I think the dividends will come in due course because eventually we'll find it difficult to multiply the rabbits. But we hope that evil day is delayed.
And even events of the last few years are encouraging in that respect.
Yes, absolutely.
Yeah.
Particularly encouraging.
Yeah. I would feel better about. Well, the last few years have been better than we anticipated in terms of being able to put money to work in ways that we think we're creating more than $1 of present value at the time we did it.
You know, Mid-America may have very unusual opportunities in the next 10 or 15 years to employ an enormous amount of capital at a very reasonable return.
Yeah,
we have some.
Perhaps $100 billion.
What?
Perhaps $100 billion.
Perhaps $100 billion,
Yeah.
and you can see why that doesn't make us too excited about dividends.
We'll think about it when we're older.
A lot older.
Number two. Yeah, we will pay dividends. And matter of fact, there may be an argument that when we pay dividends, we should pay out almost 100%, because it does mean that we lost the ability to find ways to invest $1 in a manner that creates more than $1 of present value for the shareholders. But let's assume you had a savings account, and the savings account paid 5%. And you had your choice of taking $50 a year out or letting the $50 stay in, and somebody would pay you 120% of that savings account anytime you wanted to sell a piece of it. Now, would you want to take the $5 out, or would you rather let it accumulate and have the ability to sell it 120 cents on the dollar, that account? Every dollar that's been reinvested in Berkshire has created more than $1 of market value. So it's much more intelligent, if you control the dividend policy of Berkshire, it's much more intelligent for people to leave the dollar in, have it valued at $1.20 or $1.30 or whatever it may be valued, and then sell off a little piece if they want the income or if they want to receive some cash. And the logic of it, I think, is unquestionable. The execution of it is a problem. I mean, the question of whether we can keep investing dollars to create more than $1 of
present market value, there's an end to that at some point. But so far, people, by leaving $160 billion at the end of the third quarter in the business, have $200 billion that they can cash out for it anytime they wish. So there will come a time, and who knows how soon, because the numbers are getting big. There will come a time when we do not think we can lay out 15 or 20 billion a year and get something that's immediately worth more than that for our shareholders. And like I say, when the time comes where a dollar is only buying us 90 cents of value, we'll quit spending the dollar. We'll give it to the shareholders. But I predict that the day that Berkshire declares a dividend, the stock will go down. I mean, it will, and it should go down, because it's an admission, essentially, that a compounding machine has lost its ability to continue on that course. Charlie?
Well, and there's nothing wrong with selling a little Berkshire stock to buy jewelry if you do it in the right place.